The semiconductor sector index, known as SOXX, is up over 60% in 2026, and we're only 5 months into the year. And semiconductor sales are on track to pass $1 trillion in 2026, which would be the first time in history. This is an exploding industry, which is why I'm getting into 6 of some of the best semiconductor ETFs, from the most established funds in the space to ones that you have probably never even heard of. So let's get right to it. This video is for educational purposes only. This is not financial advice, and I'm not a financial advisor. All investments carry risks, so always be sure to do your own research. So what's the big deal with semiconductors? I want you to think about some of the things that you use and see on a regular basis, like your cell phone, your laptop, the cars on the road, or even the AI chatbot or tool that you used. All of these things and much more run on chips. Semiconductors are not a trend, they're the backbone that basically powers the entire modern world. Some of the biggest companies in the world, like Google, Amazon, Meta, and Microsoft, are spending hundreds of billions of dollars in AI and AI infrastructure, which is playing a huge impact in the demand of semiconductors. And speaking of demand, this brings me to memory, specifically high bandwidth memory, or HBM, which is a major bottleneck for AI. This heavy demand in AI and AI infrastructure helped to create this memory supply shortage, which is why the memory industry has been exploding and the revenue is likely to increase 3 times from last year. So there isn't just one part of the industry that's pushing this growth. The amount of chips that is needed is continuing to grow, and the long-term potential of this industry is pretty clear. So let's talk about the best way to get exposure to this market through these 6 semiconductor ETFs. First up is PSI, the Invesco Semiconductor ETF. This fund tracks the dynamic semiconductor Intellidex index. And this index invests in US semiconductor companies that are based on factors like price momentum, earnings momentum, quality, management action, and value. So it's not just randomly selecting the biggest names, it chooses companies with strong fundamentals that have the best potential for appreciation. And the index is rebalanced every single quarter, and for the cost, the expense ratio is 0.56%, costing you $56 yearly for every $10,000 invested. For the portfolio of PSI, this ETF has 31 holdings. And for the top holdings that make up this fund, we have MaxLinear, AMD, Micron Technology, Texas Instruments, Broadcom, and more. For the breakdown of the sectors, 65% is in semiconductors, and then you have 30% in semiconductor materials and equipment, and about 5% in electronic equipment and instruments. So you can see this fund doesn't just hold stocks that make the chips, but also the companies that build the machines and the materials in the chip production process. And for the performance, it's nothing short of great. Over the past year, PSI is up over 200%. Then the annual returns of the last 3 years is 53.5%. The 5-year annual returns is 27.4%. And it had 32.8% annual returns over the last 10 years. Some amazing returns over all those time periods. Now, the difference maker with PSI is how it chooses those stocks based on those key factors. Every quarter, it filters stocks with good fundamentals based on price and earnings momentum, quality, value, and management action. So it's not just copying the layout of the semiconductor sector, it's refreshing what's the most attractive throughout the year. For the downsides, one of them is the higher fee of 0.56%, which is on the higher end of the list. Also, the quarterly rebalance makes the turnover rate in this fund much higher, and that's because of its specific filtering process. So the stocks that you have in this fund could rotate much more than the others. But PSI's strategy for semiconductor stocks goes well beyond a regular standard market cap weighted structure. This fund is for those investors that want exposure to the semiconductor industry with a more selective approach to the stocks in his portfolio. Coming up at number 2, we have SMH, the Van Eck Semiconductor ETF. SMH tracks the MVIS US listed Semiconductor 25 Index, which includes companies that are involved in semiconductor production and equipment. To qualify, the stocks must generate at least 50% of their revenues from semiconductors or semiconductor equipment. So it's only choosing companies where semiconductors are part of their core business. Now, SMH is market cap weighted, so the larger stocks are going to make up a bigger portion of the portfolio, and twice a year or every 6 months, this fund is going to be rebalanced. As for the fees, SMH has an expense ratio of 0.35%, costing you $35 yearly for every $10,000 invested. For SMH's portfolio, it holds 25 stocks in total. The top holdings include Nvidia, Taiwan Semiconductor, Intel, Broadcom, and AMD, which over half of the fund is just in those 5 names. And the sector exposure is spread across semiconductors and semiconductor equipment companies. And for the best part, the performance over the last year, SMH is up over 150%. And the 3-year annual returns is 60%, 5-year annual returns is about 34%, and over the last decade, it's had annual returns of 35.7%. Some incredible returns for this fund over a long time period. SMH is the largest of the semiconductor ETFs, so it's kind of viewed as a benchmark for the industry. You're getting exposure to some big players in the industry, so the leaders of this market are going to be the main driver of this fund. But this concentration is also a trade-off. Having over a quarter of the fund in NVIDIA and Taiwan Semiconductor, for example, mean that any bad news from either one of these stocks could have some pretty large price movements for the fund. That, of course, works in the opposite direction, but it's just something to consider. It's also giving you a lot less exposure to those smaller companies since it's so top-heavy. SMH is still a great choice for exposure to the best US semiconductor stocks on the market, and if you're someone who wants to get that exposure to the companies that are leading the market, then this is definitely one to consider. Up next and third, we have soxx, the iShares Semiconductor ETF. This ETF invests in the NYSE Semiconductor Index, which includes the 30 largest companies within the industry. Unlike SMH, this fund has some limits in place for the stocks that it holds. For example, the top 5 stocks of soxx are capped at 8%, and the remaining stocks are going to be capped at 4%, which makes it have a much more evenly spread and balanced portfolio of stocks. And the fund is rebalanced quarterly, and it comes with an expense ratio of 0.34%, costing you $34 for every $10,000 invested. And the portfolio of soxx is made up of 30 holdings. And the top holdings for this fund are Micron, AMD, Broadcom, Intel, NVIDIA, Marvell, and more, with the industry breakdown being mostly made up of semiconductors and the rest in semiconductor equipment. You can see what I meant by the stock caps in the top holdings, which really keeps some of those companies from making up a huge majority of the fund. This is another high performer where over the past year, soxx is up over 170%, with a 3-year annual return of 50.8%, 5-year annual returns of 27.8%, and it delivered annual returns of 33% over the last 10 years. I mean, the growth speaks for itself. And soxx is a bit more balanced in its risk than other funds. A market cap weighted fund with no stock cap limits in place means that a company can play a huge part in how the portfolio moves. But with the stock cap limits in place, it creates some more opportunity since there's larger allocation to those smaller companies. But when big names like NVIDIA and Taiwan Semiconductor are making a run, funds like SMH that have a lot more exposure are likely to outpace soxx in that time period. Either way, soxx is a great option for semiconductor exposure, and if you're looking for a fund that comes with a better spread of exposure to companies, then this is one to definitely put on your list. This next one is very different, and that's DRAM, the Round Hill Memory ETF. DRAM is an actively managed ETF that's focused on the memory side of semiconductors. It's the first memory stock ETF that gives you exposure to a mix of global memory chip companies. These are companies with at least 50% of their revenue or profits that come from the development or manufacturing of memory products. This includes things like HBM, DRAM, NAND flash memory, and more. So this isn't like the other funds that are giving you broader exposure to the semiconductor market, and instead is purely focused on the memory layer. And this fund is going to be rebalanced quarterly with an expense ratio of 0.65%, costing you $65 for every $10,000 invested. Because of this, DRAM only has 13 holdings in its portfolio. And the top holdings that make it up are Micron, SK Hynix, Samsung, SanDisk, Seagate, and more. And these top 3 stocks really stand out since they make up nearly 75% of the entire portfolio. And unlike some of the other funds, DRAM isn't as exposed to the US since most of the exposure is in South Korea due to SK Hynix and Samsung. Since DRAM was created in April 2026, it barely has any history, but the crazy thing is that it's had returns of about 90% in the past month and a half that it's been around. I think this shows the crazy level of demand and growth that we've been seeing pick up in the memory space. DRAM is pretty straightforward. It's giving you that pure exposure to a slice in the semiconductor industry. And the supply constraints in memory are one of the major bottlenecks in the AI infrastructure build-out, which really highlights some nice potential for this fund. But that doesn't take away from some of the risks that come with this fund. The top 3 stocks make up close to 75% of the fund, so these stocks are really determining on how the ETF moves. And if just one of these stocks takes a hit, it can have a huge impact on the portfolio. Second is that this fund is super concentrated since you're invested in the memory theme, so you're 100% exposed to whatever happens with memory. Simply put, DRAM is a high conviction play on the memory layer in the semiconductor industry. It's for those investors that want fully focused exposure to memory stocks, and they're okay with the fact that this fund doesn't have much history. The fifth one on the lineup is soxq, the Invesco PHLX Semiconductor ETF. This fund tracks the PHLS Semiconductor Sector Index, which holds the 30 largest US listed companies in the semiconductor industry. So unlike DRAM, this is a broadly exposed semiconductor ETF. This fund also comes with some stock cap limits where the top 3 stocks by market cap can't make up more than 12%, 10%, and 8% of the fund. And all the other stocks can't make up more than 4% of the portfolio. And the index is rebalanced quarterly and reconstituted annually, and it has the lowest expense ratio out of the group at 0.19%, costing you $19 per $10,000 invested. For soxq's portfolio, it holds a total of 30 stocks. With its top holdings in Nvidia, Broadcom, Micron, Intel, Texas Instruments, and others. And the industry breakdown is mostly semiconductors with a small chunk towards equipment production, which is expected for a broader semiconductor ETF. soxq was created in June 2021, so it has a decent amount of history, and in the past year, it's up over 165%. The 3-year annual returns are 53%, and it's had over 28.5% annual returns since it was created almost 5 years ago, which are really great results so far. It's hard to go wrong with this fund since it tracks a pretty large index that gives you exposure to a variety of semiconductor stocks. It also has a more balanced approach with the stock cap limits in place and is the cheapest of the semiconductor funds. And while it doesn't have a long history, it's pretty closely structured to older semiconductor ETFs like soxx. And if you're someone that's looking for a solid semiconductor ETF that's broadly exposed with a nice low fee, then soxq is a good option. This next ETF on the list is ftxl, the First Trust NASDAQ Semiconductor ETF. This fund tracks the NASDAQ US Smart Semiconductor Index, which has a factor ranking approach to choosing its stocks. First, it picks eligible semiconductor stocks and then ranks them across 4 factor scores. This includes a profit score that's based on gross or net income, a return on asset score, a momentum score, and then a value score that's based on cash flow. And then the top ranked stocks are what make it into the index. And the percentage weights of stocks are based on each company's operating cash flow relative to the total cash flow of all the holdings. So basically, a company that's generating more cash flow is getting a larger weight. From there, the top 5 stocks are capped at 8%, and all the other stocks are limited to 4% of the portfolio. So its filtering process is pretty unique compared to the other funds. Also, ftxl is reconstituted and rebalanced twice a year, and it comes with an expense ratio of 0.60%, costing you $60 for every 10K invested. For the portfolio, ftxl contains 34 holdings. And the top holdings are Intel, Micron, Qualcomm, Broadcom, Nvidia, and a few more. With a nice chunk of Intel at the top, you can tell that this is definitely not your regular semiconductor fund, but that's that factor scoring at play. And the industry breakdown is about 80% in semiconductors, with the rest left over in equipment. Like the other funds, this fund is backed up by the numbers. With the 1-year return of over 212%, 3-year annual returns of 53.3%, 5-year returns of 28%, and annual returns of nearly 29% since it was created almost 10 years ago in September 2019. What makes ftxl so different is its strategy of ranking stocks on factor scores and adjusting the weights based on operating cash flow. This approach lets it pick stocks based on certain financial qualities and not just based on size. Something to note is that you won't be getting some of those international names like Taiwan Semiconductor, SK Hynix, and Samsung in this portfolio. And this might be important for those of you that want more of the global exposure to semiconductors. And there's some big semiconductor names that are based outside of the US. Also, since this fund isn't rebalanced as much as some of the other funds, there could be a lag in the fundamentals of the stocks not matching the portfolio weights. But if you want a different approach to selecting quality semiconductor stocks, ftxl is definitely one to consider. Now, there are some important things to be aware of with this sector and these ETFs. First is that the semiconductor industry is very volatile. This is a segment within the tech sector, so there's no protection if the industry takes a hit. Whether that's from tariffs, bad earnings, geopolitical issues, or a change in market sentiment. This comes with the territory of an ETF that's concentrated in just one industry. Next would be keeping an eye on valuations since the industry is having a historic run-up. All these funds have gone up well over 100% in the last year alone, with some of their stocks going up 2 or 300% or more in the past year. This doesn't mean that semiconductor growth is over or slowing down anytime soon. This just means that there's more opportunity for things to go down. Bad earnings or any signs of a slowdown or negative news could have a big impact since expectations are sky high. I believe the long-term thesis still holds true, but just be aware of what could happen in the short term. Third would be that international exposure can vary between these different funds. For example, SMH holds Taiwan Semiconductor, while ftxl doesn't, and DRAM has SK Hynix and Samsung, which you don't find in the others. So if you only wanted the US, you'd probably lean towards ETFs like PSI, soxq, and ftxl. This next one is that some of these funds have a short track record. Funds like soxq aren't a big deal since it's not that much different than the other broad semiconductor funds. But with DRAM, it's a very new fund with very limited holdings, so you have to be much more intentional about investing in that fund and the stocks that it holds. Now, if you're still looking for other ETFs with a lot of growth potential, in this video here, I ranked 23 high growth ETFs to invest in, so you're bound to find something that fits your investing goals. And if you made it to the end, I appreciate you watching. Don't forget to hit that like button and subscribe for more content, and I'll be seeing you in the next one.